Hi everyone, welcome to this live mini weekly show. We are here to review what we can expect for the market these days and the upcoming and see what the fundamental calendar has for us and so the currencies. So let's start by sharing the calendar and checking in there what has been happening and what will happen, but not before saying that indeed, last Friday non-farm payroll report was a game changer in the market, right? It was one of the worst readings in jobs creation in the US for over 6 years. And the greenback plummeted after that and remains under pressure and will probably remain so because this is taking out of the table any chance of a US rate hike this June. Of course, we had Yellen yesterday on the wires. She was speaking about the economic outlook, and the decisions the Fed takes. Not in fact as a Fed event, but in a private event. But anyway, I do believe that her big tone on what's next for the U.S. Economic policy, has probably put another stone in the way towards a rate hike in the U.S. Last week we have been talking with Yohai when we covered Live the ECB that none of us believe that the U.S. will be able to raise rates this summer, and I have a stronger conviction on that these days, particularly after what happened on Friday and the lack of conviction showed uh, by Chilean yesterday. Anyway, there's a lot going on in the market, and currencies are are having their own life, right? We have Brexit fears and the polls affecting the pound. We have the Reserve Bank of Australia helping the Aussie recover ground. We will discuss each event, but for now, we will take a look at what's ahead for today and the upcoming days in the calendar. And to be honest, I was taking a look at today's calendar, and I see no a real reason to worry about calendar today because we have really little data in the US, some minor employment reports, the Red Book, uh, consumer credit change, nothing really that can affect the market or can boost the greenback back towards the upside, even if they are positive. So, um, overall, I do believe that the only concern will be during the upcoming Asian session, the GDP in Japan. And will be, I do believe, a second revision. We know that Japan has avoided deflation for a few, and growth is also very tepid at the beginning of the year, right? We had a zero point 0.4, and this is expected to be reviewed up to zero point 0.5. But overall, things are not going good in Japan, and we really need a strong figure in here uh, to boost confidence in economics, which the market don't have these days. But overall, I do expect the Japanese yen to keep strengthening. Okay, on the upcoming Asian session, also early Wednesday, we have trade balance and export and imports from China. This is quite relevant reading because not only for China or for the Aussie or for the greenback, because the economic slowdown that has been affected the most major economies since late 2015 has been coming from China, right? And the fact that China is not importing enough, not exporting enough, not producing, no demand. In fact, China, Japan are the main buyers of energy commodities such as oil, right? And the strong plummet in oil prices has came by the end of the Chinese economic slowdown because of a lower demand we had in the year and the oversupply we are in the rest of the world. That's why this reading is so relevant today, because if we had a strong number of imports, a strong increase and not another decrease as we are expecting, a lower decrease than before, the market will gain confidence, and that will probably boost particularly stocks, right? And of course, have the OC to keep on running as it's doing. But overall, it's a sign of a health of the world. So it will be quite relevant, and the market will trade it accordingly. Later on Wednesday, the UK will publish its latest manufacturing and industrial production figures, and this will be the first relevant data we are going to get from the UK this week. Uh, Growth in the United Kingdom has been for the most tepid over since the year started. Ratings have been quite disappointing, and in fact, we are not expecting nothing encouraging here. So I do believe that another bad number will probably erase today's wild spike in pound and send it back lower. I still believe that the pound has chances to drop towards 42.50 during the upcoming days, and even lower ahead of a referendum. But the market will be trading the pound nervously, and uh, beware of that, and beware of going up bull in the pound. I do believe that up spikes are still chances to sell. So if the data is a little encouraging, the pound may rise, but that will be an opportunity to sell for me. Anyway, the Reserve Bank of New Zealand will have its monthly economic meeting. I don't expect a rate cut in here, but they can surprise us with that, and that will probably affect also the Aussie and the Canadian dollar, all the commodity related block. So beware and take a look on whatever the Reserve Bank of New Zealand does tomorrow night. On Thursday, Chinese inflation seems to be the most relevant figure to watch during the Asian session, as again it will tell us how the economy is doing and how the world will be doing during the second half of this 2016. Right, there's a lot of hopes that the slowdown, the economic slowdown, is going to get reverted during the second semester of this year. So keep that in mind, because we need a lot of positive data coming from China first, because they are the first ones to release, to confirm or at least to build up hopes that things can change. Okay, keep that in mind. Um, UK trade balance, it's not as relevant. I don't expect them to be a big market mover for the pound. And then we jump into Friday, sorry, when we have inflation, wholesale prices, and all inflation data from Germany. I don't know if you have noticed it, but lately data coming from Germany has been quite disappointing, right? It has begun to disappoint, and that's a major concern, because the only growth we have seen coming from the euro area lately, it's just because the German economy remains strong. As usual, it's carrying on its shoulders the weight of the whole region, I do believe, right? So if we see some negative figures coming this time from the whole of this inflation data from May, I do believe that the euro will be in trouble regardless dollar weakness. Okay, that's why we have seen most major rally these days in the euro. Yeah, we had a nice brutal spike up to 1350 region, but take a look, it's unable to move beyond 50 pips intraday ever since the week started. The euro is still weak, right? Not weaker than the greenback, but still weak. So take that into account when you're wanting to trade euro. Of course, if this German data is actually good, then we could expect the euro to finally rally back. But we are going to take a look at the levels right now and see what we can expect from a technical point of view. We also have employment data in Canada. Canadian dollar has been quite strong, uh, mostly because oil prices are recovering and pressuring the $50 a barrel level, but also because the strong momentum we are seeing in stocks, the confidence that has returned to the markets. And there is a good chance that if these readings came a bit better than what we are actually expecting, because as you can see, we are not expecting much changes from May employment data, Canadian dollar will keep on rallying. However, remember that Canada and the United States are quite linked, right? They are neighbors and commercial partners. So if we had a really lousy employment reading one of the economies, there's a good chance that the other one will have a similar reading, right? There's a good chance Canadian dollar will be bad. It's true that most of what happened in the US with the employment report was because of a very soon strike that took off around 38,000, I do believe, or 36, sorry, thousand people out of the job with in that huge number. But if you add those to the actual reading, we are not even around 80,000 new jobs created on May. So beyond the very soon strike and the very soon woes, the fact is that employment data was really, really bad. And that could be the similar case in Canada, okay? To close the week, the Reuters Michigan Consumer Sentiment Index, it's usually moving the market, not much, but it will probably do. And if it will probably, let me find the right words to say this, it will probably help the flow, you know? If the dollar is under pressure, and this is a bad number, the dollar will probably keep on falling and or accelerate its decline. On the other hand, if the dollar is bullish and the reading is better than expected, it will probably fuel that advance in the greenback. But anyway, the reaction is always short term, right? Keep that in mind. But it's a kind of data that fuels the ongoing movement. Of course, if it goes in line with it, right? Anyway, let me remove the charts. Sorry, the calendar, and go to the charts. Okay, here we are. Sorry, guys. Winter has been quite rough in here. We're all sick. Anyway, I do believe that you are now seeing my euro-dollar chart. Yes, you are, right? And as I was telling, the pair has come to this 13-15 region with the non-farm payroll report, and we have been hovering back and forth some 40, 30 pips away around that level, and there's not much reaction. I have placed that Fibonacci retracement, right? That it's all about May slide, right? And this is the May slide, right? And see the pair has been has bottom sort of around the daily ascendant trend line coming from November lows, right? So the upward move was a bit beyond what we should have expected, but it was helped, of course, by the payroll. Anyway, as you can see, we are hovering around the 50% retracement of that level, and the pair is unable to go higher, right? That is not able. Still, I don't see how or from where the greenback can get some strength. So if we have the clients, that will be short-lived. The immediate support comes around 1330, 1320, where I do see some buying interest. Searching daily basis, we have been there before. Is a static level from the past also. So if we take this low down, we can go all the way down to 1290, which is 1280, which is the next strong support, and the 38.2% retracement of the same incline. And I do believe that there we can see some buying interest back. So I'm not betting too much on a break below this level, right? And remember, we are a week away from the Fed meeting, right? It will be not tomorrow, but next Wednesday. So I do expect some uncertainty and some ranges ahead of that news, particularly in the euro and the Japanese yen, okay, against the greenback, of course. And those two will be in wait and see mode for a week. Now, of course, we are going to have some movement in today, but not, I don't expect too much. Nothing really relevant. Yesterday, we saw a spike up to 14, and the bear is still short of the level. And the fact is that I'm looking for a break above this 14-15 region, which is the 61.6%, 61.8, sorry, percent retracement of the Shen decline, to see the pair going up to 1460. Again, this 1416 comes to play. If you take a look at the daily or the weekly, you will see that we have been standing around 1460 there, right, ever since early 2015, a year and a half already, and we had barely a couple of spikes, short-lived spikes above the level, but the pair quickly retraced. So 1460 is the main bullish target. I don't believe that we are going to see a catalyst strong enough this week to send the price above it. But if somehow it breaks above it, there's scope to test that 1615, I do believe it was. Yes, the high post last May. Yeah, 1615. But still, I'm betting for a short-lived move above 1460 now. Uh, After the Fed, we are going to see a totally different picture. And if the Fed stays on hold, we are close to that level or the 1416. We will probably break beyond it. And there was a good 120 pips room above that level, that high, right? Towards August 2015, I believe a high around 1730 or so as the next bullish target, but that will be for the next week and for the Fed. Okay, and the pound, well, over the weekend, there have been three Brexit polls showing that the leave is ahead of the remaining, right? And all of a sudden, we have a downward gap in pound at the opening of the week and a 200 pips over 200 pips decline down to 43.50. The pair recovered yesterday, and I do believe that there's not much explanation behind this spike we had late Asian session. I have been reading about market trying to justify this movement, either with a fat finger, either with a Brexit, a new Brexit poll, right? Whatever, we have that wild price action that has left us a bit out of place, right? Bad standing, not well prepared for that move. But what I'm seeing right now is not, it remains limited, but overall the pair is range out. And this won't be the first nor the last wild move we are going to see ahead of the referendum. Beware, because this stuff will happen multiple times until June 23rd, when we have the referendum. And after that, when the results are out, we will probably have another wild move and then market settling, right, accordingly to the result. But this is not strange, as strange it is. This is not strange ahead of a referendum, okay? And we were going to see a lot of this happening. Anyway, as I was saying earlier, I do believe that the market is willing to sell rather than buy the pound, despite what that wild spike. And I'm still looking for a probable 42.50 in here. Of course, the immediate support will be 45.20 right now. If we take this level, the pair will probably go back to the 44.60 region. Yes. And below this level, we have supports around 44 and that lows around 43, 30, 50 that we have plenty of during the past few days. To the upside, I do believe that if we take this 46, we can go up to 47, 47.10 and up to 47.70. That's the most I can see the pound rising in a wild spike. I do expect selling interest to surge if we go up to 47.70. Okay, again, this week we are talking about this week and not what may happen with the Fed or the referendum, but indeed it will be an interesting month that's shown. Anyway, and for the Aussie, the fact is that the strong dollar sell-off trigger last Friday has helped, particularly, right, base metals to recover ground, right? And while the Australian economy is trying to detach itself from being just a mining country, the fact is that it still is, right? We have gold recovering $35 in a day. We have copper, silver jumping 2% and counting, right? So that is what helped the Aussie begin its recovery. And the Reserve Bank of Australia during the past Asian session did the rest as the bank left rates on hold, and it was not as dovish as expected, right? We know that there's the door open for further easing, but it's not something that seems that much likely right now. Furthermore, there's practically no chance that the US will raise rates, so that's what's helping the Aussie dollar to rally. Anyway, we have reached a major resistance level, 38.2% retracement of the year's decline, so some consolidation in here seems quite logical. But I don't expect much more movements in here today because of the wide range we have already. But of course, we can go up to the 74.90 region if we take the daily high and particularly another weakness, right? That's the most the pair can go today. Anyway, further gains beyond 75 will probably put us back in track to test 76 this week. Uh, and actually, I don't expect it much more from the Aussie because I believe that the Reserve Bank of Australia head, Glenn Stevens, will start to whine back about the strength of currency. I'm pretty sure he will be much more comfortable closer to 70 than to 80 as we have been late April, right? So he will try, of course. Central bankers try a lot, but they not always can do something. Anyway, if the level holds, we can go down to 73.70, right? That's my first support, and 73.30 is the next, and this is one is the critical one, because if we lost 73.30, there's a good chance the pair will go back towards the 72 region. There's a nice empty space in between those Fibonacci levels that the pair can move between with not much in the middle and go pretty much straight. As I was saying, Canadian dollar is pretty strong due to oil prices. We are fresh 2016 highs. We are going about 15 year for the Canadian dollar. To be honest, remember we talk about this broken trend line and the chance of a recovery. Well, forget about it. The pair is now on the bearish track, and I could expand to believe that we are coming back to 25 on 25.50 this week. That seems a probable bearish target should oil prices continue running, which seems logical. About oil, I just want to add that um, the recovery has been nice ever since testing 25. Uh, the the bullish tone prevails in the daily and the 4 charts and many charts, but to be honest, I don't really see a 60 or 70 or nothing like that. I believe that we are going to enter in a consolidative stage, right? With some, of course, movements in the way when we have big market movers, but honestly, unless we have clear signs that demand is picking up and that the uh, global oil glut is over, we are not going to see nothing wild in here. I believe that in between 50 and 55 will be the logical, um, the fair price for the oil barrel, and that it will take a while for the commodity to move away from that level, right? Strong signs and all that. And even we can go down to 45 without really harming the ongoing upward tone. And to close the day, we were going to discuss the Japanese yen. Honestly, the bearish tone in here is quite strong, quite clear, and our move seems pretty much corrective. The price has been rejected from the test of the 100 simple moving average and daily chart, and it has come back like vengeance with vengeance, closer to the 55, 105.50, sorry, low that we had for this year, but not enough. We have recovered some ground and currently stuck around a small a Fibonacci retracement, sorry, but uh, I don't know. It will depend on the Fed next week, guys. There's a slightly positive tone in the short term in here, but overall, I do believe that the pair is bearish, and the market will use any possible trigger to sell it back. I would say that as long as we remain below 108.50, right, The chances are the risk is towards the downside, with approaches to this level being selling opportunities. Okay. And of course, right now, the immediate support or the level to break is 107, because if we take that low, and the pair will probably go below. That's 106.30. We post on Monday and approach this 105.50 we had from early May. Okay. Anyway, to wrap up this, the dollar is weak. Currencies are moving on self strength or weakness. I don't trust the euro, right? Particularly if German data keeps on going weak. I don't trust the pound ahead of the referendum. I do believe the Aussie and Japanese yen and Canadian dollar are probably the strongest currencies we are having in the States, and of course the Swiss franc, although I don't trust in it either in the States. And for the most, I could expect some range trading in the euro and yen, particularly as head of the Fed next week, uh, with the risk of both currencies uh, towards the upside against the dollar. Okay. Uh, uh, Forgot to say it and worth mention, we have the Fed on Wednesday, June 15, and uh, some hours later, at the beginning of June 16, the Bank of Japan. So it will be quite a wild ride for the dollar Japanese yen next week. Okay. Okay. I do believe that's it for today, guys. Thanks for being here with me. Thanks for sharing these moments, and hopefully we will be back soon. Okay, here we are. Okay, sorry. See you back soon. Okay, thank you and bye bye.